Good morning or afternoon, ladies and gentlemen. Welcome to B2Gold's second quarter and first half 2020 financial results conference call. I would now like to turn the call over to Mr. Clive Johnson, President and CEO. You may proceed, Mr. Johnson.
Thank you, operator, and thank you all for listening in. We've got the B2Gold executive team either here in Vancouver in the boardroom or on the phone. We're here to talk about the second quarter results for financial results for 2020 and for the first half of the year. Obviously, another very strong quarter for us. We had records for gold revenue and operating cash flow from quarterly records, and we had a good beat for budget on our operating cash cost per ounce and our all sustaining cost per ounce. And we are announcing as well that we are doubling our dividend again from 2 cents to 4 cents a share, and that reflects the remarkably strong financial position we find ourselves in. Obviously, gold prices help. We're in a very strong position, and we're announcing that we intend to fully repay our revolving corporate facility in the third quarter of the year. We're in a net positive cash position today, so great place to be in given our remarkable projected totals of cash operations this year. We're expecting. We thought it was very appropriate to increase the dividend to 4 cents a share. So before I hand it over to Mike Cinnamon to give you a rundown on the financial results, and then we'll have a quick update on the Fekola expansion, and then we'll open it up for any questions that you have. I'll just talk a little bit about COVID. You know, we've done extremely well as the financial results and the operating results suggest over the last couple of quarters despite COVID, and I think there's a couple of reasons for that. We've done so. One of them, I think the first one is experience. You know, one of the things about our group that's quite extraordinary is the amount of experience we've had in this industry, not only in the industry, but working together through the BMA years and into the B2Gold years. So when you do that internationally, you learn a lot, and you learn a lot about things like logistics and moving people, and we faced a lot of challenges over the years. We welcomed a good challenge, and we took COVID on very early and took it very seriously very early. But I think the experience of our team and the experience of our people on site really came to the forefront in terms of our ability to adjust, to manage, and so that problem solve during COVID. The other thing that's key, I think, is the culture. You know, we talk a lot about endeavoring to treat people with fairness, respect, and transparency, the way we run our business. And I think the fact that we've done so well is partly because of the mutual trust that we've developed with both our employees, our unions and our non-union employees, and also the governments in the countries in which we work in. And I do think when you treat people with fairness, respect, and transparency, I think when you run into a time of crisis, I think that can really pay off because our employees in the governments we work with, they trust us. I think they know we're looking out for their best interests. So we all had something in common, the employees, the governments, and ourselves, the company, which was to continue to keep mining if we could do it safely during COVID, and to take the various necessary steps in each of the different countries, and they all have different challenges, generally, but also in COVID, they all have different challenges. But I think that ability to work so early on with government and with our employees towards a common goal of safely mining was really an important part of the success here. And obviously, we've made significant donations to help with COVID in the countries that we're in, including here in Vancouver as well. But I think that common trust has been a really important part in our ability to deal with it. Because we hear a lot of people talk about political risk, and we're in some countries where traditionally sometimes other people may have feared to tread. But at the end of the day, we want to be in countries that want us. We don't mind being in countries that need us. And the countries we're in, they don't have a big safety net like some Western countries. So to continue the gold revenue was hugely important in these countries, and continue the jobs was hugely important. So the governments were very open to listening to how we could work together with them and our employees to run it safely. So I think that there will be some positives that come out of in the future when people look back on COVID. And I think one of the positives is going to be governments looking back and saying which industries were good to have in your country at the time of COVID. And I think the mining industry is going to be one of those industries that looks really good. Perhaps it will even mean that there will be more countries in the future more open to mining, because of the fact that we could do it these days so responsibly, and not just us, many others in the sector as well. So we can answer specific questions if you have them on our treatment or our dealing with the COVID pandemic, I just wanted to touch on some of the bigger picture reasons why I think we continue to succeed in a challenging environment. With that, I'm going to pass it over to Mike Cinnamon to give you a rundown on the financial results. And then, as I said, Bill will give us a quick update on the Fekola expansion, which is going extremely well, and then we'll open up for questions. So, over to you, Mike.
Thanks, Clive. Start with the earnings statement. Revenue first, so $442 million, a quarterly record for B2 on sales of 257,000 ounces at an average realized price in the quarter of $1,719 per ounce. And it's remarkable to say that, please say today we've sold some gold north of $2,050 per ounce. It's quite amazing, the gold price. It's hard to even say that number. Also to comment on the sales side, we actually sold 17,000 ounces, or close to 17,000 ounces more than we produced. And that was mainly due to the drawdown of some Fekola closing inventory that we had at the end of Q1. If you recall, the end of Q1 is just when the impact of the pandemic was first being felt at a number of the sites, most significantly with the timing of charters and commercial flights in and out. So we had a little bit of gold built up at the end of the quarter, but we were able to sell that down in the current quarter and into higher gold prices. Moving on now to the production side. So from the production from our continuing operations, our three operating mines was 240,000 ounces. 8,000 ounces ahead of budget, led mainly by Fekola and Ochoco, with Masbate broadly in line. And then if you add in our share of equity investments, which are basically our share of caliber ounces, they reported our share was 2,000 ounces for a total of 242,000 ounces of production reported in the quarter. Fekola was the main component of it, 147,000 ounces, 6,000 ounces ahead of budget, and it continues its very strong operational performance. Process throughput and recoveries were better than budget, and head grade was in line with budget. And again, I think Bill's going to give a rundown on how the expansion of Fekola is going after this presentation, but suffice to say it's going well. And, we've seen the benefit of getting that fleet, the expansion fleet up and running early in the year and seeing those, the benefit that has in the stockpiling strategy and also in our ability to mine tons and mill throughput. Then Masbate, 49,000 ounces, pretty much straight on line with budget. And, and that's even despite being limited by a reduced workforce due to COVID-19. We had a reduced workforce through sort of half of the second quarter, before it came back up on pretty much full strength by mid-May. And in line with budget, during the second quarter, processing was generally in budget. Mill feed grade was 0.94 grams per ton, slightly lower than budget, and then recoveries were higher than budget. Recoveries were higher due to mining more oxide than we had planned or modeled, and grade was slightly lower, mainly due to the fact that we're into Montana now, and due to sort of prior artisanal mining activity at Montana at the surface level, grade was slightly lower than we planned. But we expect that impact to disappear as we move slightly deeper into Montana and into the harder ores there. Ochoco, 43,000 ounces, 1,000 ounces ahead of budget, and Ochoco just continues to tick along. Another solid quarter. Processed tons and recoveries were slightly better than budget, but pretty much in line. And as a reminder, too, it's higher than last year just because we're into the higher grade ore from Wolfjag this year. And then looking at what that does on the cost side, cash costs for the quarter is $390 per ounce. $42 per ounce less than budget for our continuing operations, our three mines, and driven by strong operating performance at all sites. At Fekola, $300 an ounce, just $6 an ounce, slightly higher than budget, pretty much on budget. And the inline cash costs were a function of higher production, as I just described, total production costs, which were broadly in line with budget, and then slightly higher than anticipated COVID costs. We had about $4 million worth of COVID-related costs, mainly payroll-related and some transportation. And in the queue, approximately $30 an ounce. So putting all that together with the higher production and slightly higher COVID costs, we came in pretty much on line budget on the cash cost side at Fekola. Masbate, $610 an ounce, $91 less than budget, and that's a function of a number of factors. As I said before, we were on budget in terms of production, but we had lower than budgeted mining and processing costs. Mine tonnage was lower than budget, and we had less waste stripping than we budgeted. And also average fuel prices for the fleet were a lot lower due to lower unit fuel costs and also lower or shorter haulage distances. And then processing costs in the quarter were lower than budget due to lower HFO prices. And I'll comment on fuel generally at the end once I've talked about Ochoco. Ochoco, $421 an ounce, $64 an ounce less than budget. As I said, just strong performance all around. Slightly higher than budgeted ounces, lower fuel costs, and a weaker than budgeted Namib dollar. And we saw the benefit of that Namibian FX running through to the bottom line in terms of costs. Overall on fuel, we did see significant declines against budget at both Masbate and Ochoco. At Fekola, a slightly different story. Diesel was lower than budget, slightly lower, but HFO was at or just slightly above budget. And just a reminder, as we put out in Q1, it's really due to the fact that in West Africa, in that collection of West African states, the fuel prices are set 1 month in advance by the government, and so they don't float directly with what you see happen in the underlying oil pricing in the world. And so generally what we've seen is that the fuel prices have remained relatively static. They did come down a little bit in Q2, but we're pretty much on budget overall in Mali on fuel, but significantly under in the other two operations. And if you add in the impact of just the very small production that we had from our pickup from Calibre in the quarter, the total cash cost rent for all operations were $390, 42 less than budget. And moving to all-in sustaining costs from our operations, $714 an ounce. That's $93 per ounce per consolidated, less than budget. Mainly driven by Ochoco being significantly under budget. And Ochoco is really a function of those lower cash costs, as we talked about, but also lower CapEx. They did see approximately, I think, $4 million lower pre-strip cost than they'd anticipated in the quarter. And some other sustaining capital expenditures were below budget by approximately $8 million, just about half of that due to timing and half of it we don't expect to be incurred through the balance of the year. And then if you add in Calibre to results, our total all-in sustaining costs were $712 an ounce, $107 less than budget. Maybe to a comment on the impact for the year. I think year to date. So I think what you'll see is those results we reported in terms of cash costs and all-in costs, they're almost exactly mirrored in the 6-month numbers as well. So what it's really saying is that we've had two very good, solid, consistent quarters, which is even more remarkable when you think about how much COVID impacted the second quarter versus the first quarter. COVID was, we started seeing it start to hit operations in March, but we still managed to come all the way through the second quarter and still stay on the same track with very comparable results to the first quarter. Okay, I'm going to comment now a little bit on the income statement, just a few comments to highlight there. Or further down the income statement. So on the G&A side, we did see lower G&A costs in the prior year by about $3 million. And the majority of that is due to reduced travel. Obviously, with COVID being in place, we've got a moratorium on other than essential business travel. And also lower consulting fees, again, as a result of less activity. Also in the income statement, you'll see $3.7 million share of income of associates. That's our pickup from our share of Calibre in the period. And just to comment on other, Clive sort of alluded on it, there's $3.8 million in other expenses in the P&L. The majority of that, $3 million, is our COVID donations that we made during the quarter, pretty much donations at all sites, and including in Canada. And the other item I'd comment on the P&L is on the taxes. Just we're fully taxable at all sites now. Any accelerated capital deductions have been used up at all sites, so we're fully taxable. $82 million corporate income tax expense for the period. We've also given some guidance on what we think our cash taxes will actually have to pay in the period. They're close to $180 million now, and those were guided at $1,700 gold. It'll be slightly north of $200 million if we stay at these kind of gold prices that we're seeing right now. And also a reminder that doesn't really reflect any increase from Fekola taxes. Fekola taxes are paid almost 1 year in arrears, so we're paying taxes this year for Fekola based on last year's installments, and then we'll true it up early next year. When you move down into earnings, net income for the period, $138 million. Our share attributable to shareholders of that is $124 million, or 12 cents per share, GAAP EPS. Once you take into account some of the significant non-cash items in there, such as derivative gains and deferred tax credits, our adjusted EPS for the period was 11 cents per share. I'm going to talk a little bit about the cash flow. Again, Clive mentioned that it's a record number for us in the operating cash flow side, $238 million. And, year to date, it's also $454 million operating cash flow, again, a record. So for the quarter, the cash flows, $238 million translated to 23 cents per share. And maybe as well, we usually give a little bit of guidance as to what we think it looks like at higher gold prices. So at $1,900 gold, we're expecting we'll see operating cash flows north of $900 million. And obviously, right now, we're even above that, so in terms of gold price. So great place to be, and lots of free cash flow being generated. And with that, I guess moving on to the financing section, you'll see in there, you'll see the $250 million in the queue that we drew as a precautionary measure on our revolving credit facility. Our plan now is to repay that, in fact, repay the whole drawn balance of the revolver in this third quarter. We're very comfortable with how the operations are running, the impact of COVID at our sites. Every site has been impacted, including Canada. However, we've managed to maintain our operations, and actually they're prospering, as you can see from the results. So strong cash flow coming from each of the ops. And given that and the higher gold prices that we're seeing, we think it's the right decision to repay that revolver. So that'll be $425 million in total that we've currently drawn on the revolver will be repaid this Q. A couple other things to mention, the cash flow statement. You'll see in there that interest expense is a lot lower than it was in the prior year, and that's just we started the year with a lower revolver balance. We've been paying that down ever since we got Fekola up and fully run. And at the point now in this quarter where we've repaid all that revolver debt, it's kind of like we got to the end of the second part of our strategy overall in Fekola, which was to build it using cash flow and debt and no equity. So it's kind of a milestone for us on the financing side to be able to repay that revolver. You'll also note there was no dividend paid in cash in the second quarter. It was declared and it was subsequently paid just early in July. That's just a function of the timing of the AGM and when we were able to pay that dividend. And as Clive announced, if you look at how our dividend has moved, we declared our maiden or first dividend in Q4 of 2019. It was 1 cent per share. We doubled that for the second quarter to 2 cents, and now it's up to 4 cents per share. And that 4 cents per share on an annual basis, 16 cents per share, translates to somewhere just up to $170 million per year in cash flow. It's about right now it's about a 2.3% dividend yield, which I believe puts us right at the high end, if not at the top of our peer group. Now, to talk a little bit about investing activities, we spent $70 million in the Q and $182 million on CapEx year to date, and we're about $38 million lower than where we budgeted to be at this point. And of that 38, I mean, a lot of it is timing, but I would say maybe 16 million of it is not likely to be incurred in the second half. At Ochoco, we got stripping savings of about $4 million, which we think are permanent and locked in. And then we've also got costs related to the Ochoco Underground development and the installation of a power line that connects us to the national grid, in total of $8 million, which we think are now going to be incurred earlier in 2021 rather than 2020. And I should highlight, we don't think that's going to change the schedule timing to get the underground up and running. When we expect, I think Bill's going to comment on that a little bit after this, but basically it's just the timing of the cash flow. And then we also saw savings of about $4 million on the Fekola tailings facility, like $4 million that less than we budgeted. That's completed, and we don't expect that to be incurred as a result. So in terms of the balance of that $38 million, we're still forecasting to be spent the rest of the year, but There certainly is some softness or sensitivity around the timing of some things like the Fekola solar plant when we re-engage there and get that up and running. Exploration is down against budget so far just because of our ability to access sites across our different operations. So we are still planning to incur that during the year, but obviously that will depend on that site access. And then Gramalote, again, timing of finishing the exploration there and getting the new model in place means that right now we're behind the budget. We are forecasting to spend that through the balance of the year. So all in all, we end the period with $628 million. And again, as Clive said, that put us in a net cash position of somewhere just south of $160 million when you take into account our debt. So well placed to repay the debt. And also, as I mentioned on the, how we see the cash flows unwind for the balance of the year, we expect to be in a strong cash position when we get to year end. And that pretty much winds up what I was going to mention in the results. A couple of just project-related things that we'll highlight as they sort of tie into discussing CapEx. Fekola, as I said, Bill's going to talk about the expansion and where we are in the solar project. Ochoco, things are going well, and that the Ochoco Underground, as a reminder, the total project is estimated to be about $57 million, and like I said, we are going to see some of the costs of the $18 million that we scheduled for this year pushed out into next year, but overall the project's on schedule. On Gramalote, maybe to highlight, we took over as manager of Gramalote effective the start of this year. Part of the commitment in order to do that and maintain it was to spend a sole fund in Gramalote for $13.9 million. 10.9 of that was to get us back to a 50-50 interest in the project with our partner, AGA, and that was funded before the end of June. And then the further $3 million was to a commitment so we would remain as manager thereafter, and that I can confirm that has now been funded. So all of the sole funding at Gramalote is $13.9 million has been incurred. And the feasibility for the project is still expected to be available by the end of the first quarter 2020. And with that, I'll wrap up the financial side of the presentation.
Okay, thanks, Mike. Before I pass it over to Bill, just maybe talk a little bit about strategy, where we are, where we see ourselves going forward. We're feeling pretty good about our long-term strategy, to say the least, over the last 12 years. And that strategy was to continue to look to grow production through accretive acquisitions and exploration, irrespective of the market at the time, the gold price at the time, or the sentiment in the market. And we look back now and we're very pleased with the fact that we stayed with that strategy. And it was quite contrarian at times. When you look back at the mines we built and the things we did over the last 12 years, it was often done at times when growth was out of favor. And it speaks to the fact that where we sit today, because we persevered with that long-term strategy, and we're one of the few companies to be building gold mines over the last number of years. So that's one of the reasons why we find ourselves in such a fortunate position. But it also gives us the benefit or the luxury of being quite ambivalent about M&A. We don't see a lot of great projects out there that we like, and we don't see a lot of good projects out there that we like at the price they're at today, frankly. And at the end of the day, we are going to be very focused on continuing to grow from our pipeline. Gramalote feasibility study in the first quarter of next year. I still don't think a lot of people are understanding Gramalote yet. I think that'll come with time. It's a very good project. It's got lots of great attributes to it. We like it a lot. We've obviously seen a change in leadership in AGA recently, which I'm frankly sorry to see. We've had a good working relationship with Kelvin and a great relationship working with the team, the AGA team that we've combined with at Gramalote. So we look forward to continuing that strong relationship. But as we go through feasibility next year, we clearly think we're going to end up with a project that's clearly financeable and economic in today's gold environment. We liked it quite a bit at $1,350 gold. So I would hope to see us in the second quarter of next year moving towards a development decision on Gramalote. But just so everyone's aware, it is a 50-50 joint venture, but neither party can stand in the way of the project going forward, which I think should be the case in a 50-50 JV. In other words, if we come up with a positive feasibility study in the first quarter of next year and EGA decided that they did not want to fund their 50% of the estimated $900 million capital, then we have written into our agreement the opportunity to purchase their interest the fair market value based on the feasibility study economics. And that goes both ways. So if they came up with a development plan and we didn't want to go ahead, a similar thing applied. They also have the option to go down to 30% instead of 50%. So we think this project, unless something really surprises in the near term, will be a mine that should be built. The risk factor right now is the infill drilling, which is going very well. The results, not surprising to us, are very good. It's a pretty homogeneous ore body. We're infill drilling it. But that'll be done very shortly, completed, and then we'll have a new resource out, and that'll all come together with all the hard work and all the detailed work that was done, a lot of good work by AG over the years in engineering and a lot of work we've done since then as well, metallurgy, et cetera. This is a very advanced project. The one thing that was lagging behind was the drill spacing. So we're improving that now. So the potential for Gramalote is 400,000 ounces, or a little over that a year out of the gate, with the most recent projected all-in sustaining costs were around $650 an ounce based on the economics that we put out on the preliminary economic assessment. So an attractive project. There aren't many of those in the world today. I'm confident we're going to see that go the next steps towards development and get developed ultimately. Kiaka and Burkina Faso becomes a little more interesting on these kind of gold prices for sure. We're looking at, Dennis is doing some good work on our engineering side, looking at some different sources of power for Burkina Faso. We've learned a lot about solar, of course, between Namibia and Mali. So that's interesting, and there's natural gas and other potential sources. So that looks like those things might improve the project, and of course, gold price helps a lot. So we'll be looking at the next few months, a little hard look at Kiaka, rerunning a new geologic model, redoing detailed mine planning, and coming out ultimately with a new feasibility study. But it's a project that, whether it's ourselves or whether it's in partnership with someone else, or we're going to look at various ways over the next number of months here to unlock the value of the Kiaka deposit, which is 4 million ounces in 4 million ounce resources that it's a pretty solid project, so good ore body. So we'll see where that goes as well. In addition, of course, exploration. We have one of the very successful gold exploration, one of the most successful gold exploration teams in the world. We'll continue exploration around the sites. We've got good results coming out of Cardinal, immediately west of Fekola. We've, of course, got the Snakes, the Anaconda area to the north, where we'll get back to drilling that 20 kilometers north of Fekola. We've had some really good results there, very encouraging, both in the near surface material separately, but also beneath that in the sulfide. Some pretty exciting opportunities there. So we'll be hitting that hard with drilling again as soon as we're wrapped up at Cardinal. And other drilling, looking around the world for world-class deposits in interesting places. So in terms of M&A, we will keep looking, as I mentioned, but we find ourselves in a fortunate position of being quite ambivalent. We don't feel we need to do a major acquisition by any means. I think you're going to see more M&A. Hopefully, we're not going to get back into the silly season that we saw about 10 years ago from now, with people overpaying for marginal assets with a higher gold price. We'll see. But at the end of the day, we've never played that game, and we don't need to start playing that game now. Just a couple other points before I pass it along to Bill. I do want to give a shout-out. I talked about how we've done with COVID. I want to give a shout-out to all of our employees, 4,200 employees, and just the incredible work that's gone on with people working extra hours, difficult circumstances, to keep these mines running and running well. Great morale throughout the company, and that's really rewarding. And as I mentioned earlier, we like to think that speaks to the culture of the company. That a great, incredible group of employees done a great job from top to bottom. So what you'll see from us over the next number of months is more drill results, more exploration results coming out of Cardinal, and also out of moving further drilling at other locations, including in the Anaconda region as well. Final mention, we officially launched the Rhino Gold Bar initiative through Kitco. If you want to buy a Rhino Gold Bar to help save the black rhino in Namibia, the beautiful bars are for sale on Kitco, or you can go to our website. And basically, it's our way of donating 1,000 ounces of gold towards helping save an endangered species in Namibia. It's very creative conservation and philanthropy. It's been very well received worldwide, and it's really important today. With COVID, we're seeing many effects. One of the effects you see in Africa is devastation of the tourist industry. Part of the tourist industry in Africa is what helps protect endangered species. So this contribution will go to helping the communities that help to monitor and save the rhinos from poaching activity. So it's a great initiative. We're proud to be involved with it, and it's kind of a new approach, which which is garnering a lot of attention. That gives us some additional ideas for how we can get back into the future as a responsible gold producer. With that, I'll hand it over to Bill to give us a quick update on the Fekola expansion.
Yeah, thanks, Clive. I won't really go too much in production, seeing as I thought the press release did a great job of putting it out. But there is one thing, actually, which you haven't asked me to talk about, but I do want to state that we've had a continued amazing run on the safety side, right? Even with the background of the COVID-19 and people working long shifts, we had a quarter with 0 lost time accidents at our operations, and that for the entire year that gives us 1 across all 3 operations. So we're seeing certainly our best statistics ever, which once again reflects on what Clive was talking about the culture and the dedication of our employees, but it also shows us as an industry leader in some of the things we're doing for sure. And with that, I'll turn my attention to Fekola. As we talked after last quarter, there's really kind of 4 phases of the expansion. I'll just quickly go through them. On the mining side, as Mike pointed out, we continue to be ahead of our development schedule. The plan was really to double our mining production rate. We got the first 2 tranches of equipment in ahead of schedule. Great job of commissioning them under COVID-19, and those are in operation and working fabulous. We've got another tranche coming in before the end of the year, and we don't see any issues with that. It looks like it's on schedule, and the team is ready to commission. So on the mining side, ahead of schedule. On the milling side, we had previously announced that we would be ready to bring that thing into production full scale at the end of Q3. It looks like we will be at or ahead of that schedule at this time. We are now in the final phases of getting our commissioning team in, so we're more than 80% done with all of our tie-ins, and the commissioning team has arrived on site. They've gone through the mandatory quarantining. They're just coming out of quarantine now and getting ready. So our plan is the middle of August, really to spin those guys up, and certainly by the end of August, we think we're going to be in pretty good shape to start commissioning and implementing that expansion. So we see the end of Q3 as a very real, doable target, and maybe even a little bit early if we can get a little bit of luck. And then the third part is the tailings facility. We did a double lift, and that's not primarily to make sure that we could handle the expansion tons in the tailings facility. We actually looked at the historical productivity out of the mill, and we're concerned that maybe we might get caught offside if in fact the mill runs better than even advertised, and so we want to make sure we had additional capacity. So we did a double lift on that, which takes us into 2023 and 2022 and beginning of 2023. That was completed ahead of schedule, commissioned before the rainy season, and that's fully operational at this point. And then the last one is the solar plant. The solar plant team, if you remember, we went to an island-type configuration at Fekola, where we basically brought all of our employees on site to protect the site and the populations against any spread of COVID-19. In order to do that, we had to free up additional beds. The solar group agreed that some of the production teams probably had higher priorities, so they stepped off of site. We took them out, but the project has continued to go forward. We've continued to receive all the materials. We've continued to put the batteries in place. We've continued to work on the design, make sure that that's all finalized, the detailed engineering. And I'm happy to say that as soon as the mill commissioning team is done and leaves site, we've got them queued up like a hockey team. They're sitting on the board ready to come in. So we're talking really mid-September, mid to late September, those guys are going to be ready to go. And we think that within 6 months, and once again, maybe a bit conservative, we might be able to do that a little bit, that solar plant will be up and operational. And just remember, the solar plant is not needed for the expansion. It's just an additional cost-saving measure that we see over the life of the mine. So we see no issues with getting that up and operational in kind of Q1 2021. Mike mentioned, I'll just quickly talk about the Ochoco Underground. The Ochoco Underground, as he indicated, is on schedule. Once again, that contract was awarded on schedule. We brought in the contractor. The portal development will be done by contractor, and at that time we'll make a decision on whether we want to continue with the contractor or we want to take it over ourselves. But that contractor is in country. They've gone through quarantining now. They're in the process of hiring all their managers and getting their team ready to go, and we see that project as completely doable on the existing schedule, so no issues there whatsoever. that, Clive, I'll turn it back over to you.
Okay, thanks, Bill. I think with that, we'll, operator, we'll open it up for any questions.
To ask a question, you will need to press star 1 on your telephone. To withdraw your question, please press the pound key. Please stand by while we compile the Q&A roster. Your first question comes from Ovais Habib of Scotiabank. Your line is open.
Thanks, operator. Hi, Clive and B2Gold team. Congrats on the great quarter, and thanks for taking my questions.
Sure, thanks.
Clive, my first question, again, it's really great to see that B2 is in a net cash position, and you're also looking to pay off the RCF by the end of Q3. On top of that, your dividend has been increased as well. So the question is how are you looking at allocating the strong free cash flow going into 2021, especially if current gold prices persist? Like, is it more higher dividends? You're looking at the construction of Gramalote, Anaconda, exploration. I mean, like, can you give us a little bit color on capital allocation, please?
Yeah, I can tell you the kind of things we're going to consider. We can't really talk too much in detail about it yet until we get to decision point. Obviously, the dividend, when you bump up a dividend like that, it's with a view that you're going to maintain it, obviously. So I think you can sort of infer that from what we're doing this quarter. And then on the capital side, the big decision points that are coming up. The first one's Gramalote with the feasibility by the end of March. We'll know what we think we need for Gramalote and whether we want to go ahead. And the indicators to go ahead, as Clive said, are good. And then we're looking at Kiaka as well now. It's having a revisit of that and what that might look like and what we might want to do there. And then also with the drill programs that are ongoing at Fekola for the snakes and the cardinal zones, we're starting to turn our attention to, based on the positive results there, what that might look like for the future as well, and thinking about what capital allocations may be. So those are really the primary things, okay, I think I would say, as for the plan.
Just to add a bit to that, you've seen a lot of companies that are doing a dividend based on a percentage of free cash flow. We haven't gotten there yet, and it's just right now, as Mike said, we're at a time of understanding soon our capital requirements going forward. Now, when you look at Gramalote, we don't need to. We're going to generate, if gold prices stay anywhere near where they are, we're going to generate well over $2 billion in cash from operations over the next 2.5 years or so. Why you'd be building Gramalote? So you can clearly do it from cash flow, but there's no, there's nothing to say you would take on a little bit of project debt along the way with that as well, because it's out there and it's going to be extremely cheap. So we're that's why we haven't defined it as a percentage of free cash flow yet, because we're in a stage of understanding what our cash requirements are going to be in terms of capital, et cetera. I mean, for exploration, you could probably assume we're going to continue to spend somewhere around $50 million a year, I think.
Okay.
And we can more detail what we see in terms of sustaining capital going forward. If you want to get into that detail, let's have a call.
Sounds good. And just changing gears a little bit, and my next question is for Bill. In regards to the Fekola expansion, so the expansion was supposed to increase throughput by approximately 1.5 million tons per annum. In 2019, the mill was already running at over 7 million tons per annum without the expansion. So, I mean, could you see Fekola, achieving approximately 8 to 8.5 million tons per annum instead of 7.5? And then, if that's the case, is this rate sustainable? And how do you see the mill ramping up once it's completed at the end of Q3?
Yeah, so I'll answer it, and then John can yell at me afterwards. So if you remember, we always said it was going to be 1.5 million plus what we think it could do when it became kind of fully production-wise. John and I have had a lot of discussions on this, hard ore, soft ore, but the other thing which is of really interest, which he keeps bringing up, is that when you're running these things so hard, if you're running up at the top end, then you really risk the additional maintenance costs and everything else that goes with that. So what we can say is that we're very comfortable with the 7.5 and probably above that a little bit. But I don't think until we get it commissioned and really see what this thing can do that we're comfortable saying that we're above 8 or 8.5. I think the 1.5 million, plus what it was originally designed at is what we're comfortable saying. And maybe a little conservative. I don't know, John, if you want to add to that.
Well, I agree with everything you said there, Bill. Yeah, it was designed for 7.5 million tons a year on hard ore. With softer ore, we will be able to achieve a higher production rate, but that'll depend on the mill feed blend coming from the mine. So after we run it for a while, we'll have a much better idea of what the ultimate throughput can be on softer feed blends.
The other thing just comes in, we're drilling. One of the reasons we're extensively drilling Cardinal now is because Cardinal has the potential to bring in some additional ore that's very close to 500 meters or thereabouts away from Fekola. So that some of that's going to be softer ore. So if that continues to pan out, that could have an impact on production, or that could be positive opposite throughput. Bill, fair to say that?
Yeah, no, it's actually a fun exercise which you bring up, Clive. We're not only looking at Cardinal, but are there things? Can we now realize the Anaconda area, that saprolite, and bring it down and put it through the mill? Is there hard sources there that we can bring down and add through the mill? All those studies are going on right now, but certainly I think we all acknowledge that the mill has absolutely outperformed what the design has been for, and we see that there is the potential, if everything goes according to plan, that could continue into the future.
And just in terms of the ramp up, I mean, do you see that taking a quarter, or is there a longer ramp up?
No, certainly in our budget, by the end of September, we're going to be up and operational. John, I mean, am I out of line saying that? Certainly by the end of September, at full.
No, I agree with that, Bill. We'll be ramped up to design throughput by the end of September. And I was just going to add that yes, if we do blend in saprolite in the mill feed, we will be able to achieve higher than 7.5 million ton per annum throughput.
All right, sounds good, guys. That's it for me. Appreciate it.
Thanks, Ovais.
Your next question comes from Josh Wolfson of RBC Capital Markets. Your line is open.
Thanks. Continuing the theme on the Fekola questions, for the third quarter, should we expect steady state production over the duration of the quarter, or is there going to be any sort of commissioning related downtime we should expect?
Well, we have 10 days put in for all final tie-ins, but we are expecting a full production for the quarter. I mean, that's all factored into the budget and the way we're running right now. So that kind of 4 quarters evenly spread out. I think it's actually slightly less, but it's within the margin of error of what we've been doing.
Okay. And then for the Fekola mine license, I guess which is slightly adjusted for the solar project, and also looking at where gold prices are today, when do you expect capital to have been repaid and the dividends start to be paid from that asset on a steady state ongoing basis?
Oh, you're asking when the initial investment, the loans that we put in to build the mine will have been paid off? I think now at these gold prices, you're looking within the next 2 years, the initial investment will be recouped.
Okay, thank you. And then last question on on the commentary for Gramalote, in looking at I guess what looks to be an optimistic outlook for that project. Is there anything else within the portfolio today which could potentially sort of come up as a higher priority opportunity, or is it safe to say that would be the number one project? I asked just because the commentary on Tiaka was I guess more constructive in the current environment, and then potentially if there's been more work done for Anaconda, could that be the case, or is that not sort of the case for maybe a mid-2021 timeline for Gramalote's decision?
Yeah, no, I think it's hard to imagine anything bumping Gramalote out of the queue because, one, the advanced stage that it's at, there's a permit in hand. We're closing in on the final feasibility, as we said. And also, it's really got some, as we said, we like the looks of that, the 1350 gold. We thought it had a good shot. So I can't see anything bumping it out of the queue. Kiaka, not as robust a project as we see it today, has potential to get better, as we said, with some of the things we're doing, fuel, power costs, etc. So I don't think Kiaka will likely bump it out of the queue. But we've always said one of our keys to our success is our focus and our accountability and our doing things ourselves. So we're not going to suddenly start building two significant gold mines at the same time. So therefore, if Kiaka is a go, and it looks interesting after this next round of a number of months of updating it, that we might very well look to partner it with a responsible industry partner to advance it as one alternative. The other alternative would be to sell it as an asset. The government of Burkina Faso is going to expect a project like that to get developed, and they have a right to. In my opinion, if it's economic, somebody should build it. So, but I don't see it bumping time-wise and also quality-wise. I don't see it bumping Gramalote out of the queue. And Anaconda, definitely, we're really intrigued by the potential for Fekola-style mineralization there in the sulfides. So we'll be hitting that really hard with drilling. But once again, there may be a situation where some ore is being trucked from Anaconda area potentially down to the mill, some of the saprolite material. But I think to actually look at building another major facility, if we're successful in finding another multi-million ounce deposit, let's say, at Anaconda area, that would become after Gramalote is my expectation, in terms of if we were going to build another major mill and maybe share the solar power plant, etc.
Thanks. Those are all my questions, and appreciate the upgrade on the conference call service this quarter.
Okay, thanks.
Your next question comes from Jordy Mark of Haywood Securities. Your line is open.
Yeah, good morning, guys. Thanks for taking the call. Nice jump in the dividend there. Loved it. I'll just continue on the theme with Josh and Ovais there. On Fekola for mining, can you remind me of what your stockpiling strategy or your cutoff is that you're implementing there versus what the reserves are quoted at? I guess that's 0.8 or something. And where the resources are quoted at for cutoffs, and if you see any sort of wiggle room in terms of looking at modifying stockpiling strategies to accommodate where your cost structure is and also where the gold price is moving.
Yeah, for me, Randy just come from site, so he's probably the most appropriate to. Randy, I don't know if you want to comment on that.
Randy on?
Yeah, sure. So the stockpiling strategy at Fekola is we've got a number of different stockpiles. Obviously, the high grades stockpile our ore down to 0.8 grams per ton right now, but we're also stockpiling much lower down to 0.65 grams per ton in a sub-economic pile that in today's gold price is definitely more economic. We are currently looking there and at Ochoco at the different cutoff grades and our stockpiling strategies. It's been hard to keep up with this quick increase in gold price, but that's what we're doing, and that's kind of the strategy right now. But we're pretty good shape at Fekola already and what we're stockpiling in our sub-economic.
Okay, thanks. And also on the, if we look at Cardinal, for instance, I mean, it's obviously pretty proximal to the existing pit. I mean, can you give us an idea of the scale of work you've been doing there on the drilling, given what it could add and its proximity, etc.?
Tom, you want to talk that?
Yeah, Jordy. Right now, Cardinal is, it's got high mineralization over at least 800 meters, and then down plunge, where the strike length of it is a couple of kilometers long, and we've drilled so far close to 26,000 meters on it. Sorry, 21,000 meters. Original plan was 20, and because of the drilling ongoing, we'll probably get close to 35,000 meters drilled on it this year. So we've shifted our focus from Mamba right now to get Anaconda to a point that we can do some decent mine planning. Get Cardinal to do some decent mine planning, but it remains open at depth and also a little bit to the south. So it's sort of developing situation, but it does have some size potential for sure.
And if I can extend on that one, thanks, mate. Is that the same type of Fekola cell mineralization? Is that a different style that you may have to do some more metallurgical work to see how it fits in?
We're doing some metallurgical test work right now, and it seems I would suspect it's going to be very similar. It is slightly different, but there's just minor differences. I would suspect metallurgically there won't be too much difference. I don't know, John, if you could add anything more with the results to date.
Yeah, all we received so far are head assays on the samples that we're going to be testing, but so we'll know within the next week or two metallurgical results. But as you say, Tom, we're expecting similar results, but we will confirm that through the metallurgical test program.
Okay, great. Thank you. And a quick question on Kiaka. Obviously, given the scale of the original sort of plan at 12 million tonne per annum there, are you looking at a potential to do what you've done at Ochoco to Fekola and Masbate in terms of potentially doing something smaller and ramping up over time, or see where you're going to trade-off balances on power availability and cost, etc.?
I have a little trouble understanding it, Jordy, but I think you're asking about is the Kiaka potential to start something smaller and grow it? Frankly, so far that's not something we've seen as a really viable alternative. It's kind of a pretty consistent kind of 1 gram ore body. It's got good things about it, but at the end of the day, we don't see a high grade, starter pit there. And when we acquired it for something like $25 million was the actual acquisition cost. When you go back to it and vault it, we always felt that it needed a better gold price, but we thought more exploration success. We had some exploration success at Toega, but it was too far away to help Kiaka. So when we did a deal with that, as you saw, so we don't see Kiaka as being. It's either going to be done as a large scale, low grade open pit gold mine. From our view, we don't see a ramp up option there.
Okay, thank you.
Thanks, Drew.
Your next question comes from Gary McCrory of Canaccord. Your line is open.
Hi, good morning, everyone. Maybe a bit early for this question, but just looking back to the feasibility on Fekola into 2021, and given what you've learned there this year in terms of the grade and how the plant's performing, and obviously you got the expansion coming right around the corner, but I think production was expected to dip into 2021 in that feasibility study. So I'm just wondering, what's the opportunity for flat production or even higher production in 2021?
So the question is, versus 2020, what's the production at Fekola?
Yeah, 2021 versus 2020. We're supposed to, the original feasibility said it was going to get what the DEA said it was going to do.
Yeah, well, certainly, I think we are going to have, if you want, I think we're going to have slightly less production in 2021. But what you have to remember is we really have a bucket there, a pretty consistent bucket over 5 years, where we're talking about 500,000 ounces over those 5 years. Sorry, 550,000 ounces over those 5 years, and we're pretty consistent with that. Where they actually fit within that bucket, obviously that depends on where we end up on our phase positions during the year. Can we prioritize and bring ounces forward? What I will tell you is that we're continually looking at the best ways to bring ounces forward. So 550 over 5 years, and
that doesn't include anything potentially from Cardinal or from Anaconda.
Yeah, that's actually a very valid point. One of the things we're looking at now is how do we as you know, we don't know how the mill is going to outperform. So we are now making some wild swings at the fence to see, is there additional capacity there, and how would we fill that if there is, whether it's from Cardinal or whether it's from Anaconda, or even maybe some of the northern zones which have yet to be really talked about too much.
And how quickly could you bring those sort of ounces in? Like, is there any permitting requirements there, or is it pretty straightforward?
Yeah, it's straightforward. Remember, we own the license. We own the license to the north as well. Most of the stuff we're talking about is in the Medinandi permit license, which is where the Fekola deposit's at. So that stuff would be relatively easy, like the Cardinal area. If it is to the north, we would have to do some work with the government to get an agreement with them as far as how they're going to share in it, or are we going to toll it. But all those things are, the government's already come to us and said they're completely open to that, and they want us to develop that as quickly as possible.
Okay, thank you, guys.
Thanks. That's great.
There are no further questions at this time. I turn the call back over to Mr. Clive Johnson.
Okay, thanks everyone for your time, and thank you, operator. We'll look forward to updating you again soon. Thanks, everyone.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.